One of the things you alluded to, which has to be a downside risk, is the recurrence of inflation. One had thought the kind of German fiscal disciplines had been all prevailing. But if you look at the outturn for 2021, US record inflation over a 20-year period, Irish inflation north of 5%. I mean, this has a couple of impacts. First of all, if your money is lying in a deposit account earning no money, you're actually eroding the value of money. What's your predictions for inflation? Because there's two schools of thought. One is this is fragmented supply problems, supply chain problems, and it's a spike. Others say, well, actually, rents and pay and everything is going to follow suit, and it's going to be endemic. What do you think?
I think inflation has taken off because of a lot of it's down to the supply-demand mismatch. But I also think there's pent-up demand there. I think people lost a lot of money, businesses. They're trying to get the money back because of the lockdowns, and they push prices up. Anecdotally, you can see that from here. So I think what you're going to see is, I think inflation, as you say, is hitting sort of record levels. I think it'll taper off somewhat. I think interest rates will rise to try and bring it down. But it won't fall to the levels we've seen in recent years. It won't fall back to 2%. It'll be above that, I think.
And is there competitiveness implications? Or is it like printing money? If everyone's at it, it doesn't seem to matter?
Well, no, I think it will have implications. I think, as you say, I think consumers are going to find it harder to, a lot of their money is going to, more of their money is going to be spent than it would have been before. I mean, prices are definitely going up everywhere, in my view. I think the ECB are going to be very slow to act. They seem to be taking this on the chin and dismissing it. I think they're wrong. I think ultimately they may have to raise rates quicker than what they're saying. But certainly the Federal Reserve and Bank of England will definitely move and hike rates quickly, I think, to try and bring inflation down.
Okay, so we've had negative, I want to talk about interest rates. We've had negative rates, we've had zero rates. I think the Fed have said sort of maybe 0.25% over 4 quarters and it go to 1%. What sort of landscape are you looking at, James, as regards interest rate predictions?
Well, I think Jamie Dimon, the head of the largest bank in the world, on Friday was talking about 4 interest rates for the Fed. Interest rate increases in 2022. But I think if you do have a rising interest rate environment, it brings you back to that, as an investor, what asset class do you want to own? And I think that does bring you back again to equities, because equities, if you're in companies that have pricing power, if you're in companies that can benefit from rising prices, can pass those through to the customers, and are also, in strong financial situation, able to manage their balance sheet efficiency, that is a much better asset class for you than cash or bonds. So it's what they call the TINA trade. There is no alternative. It's a bit simplistic, but I do think that in the environment you're talking about, you still want your default investment is still equities.
I remember at a particular point in time, interest rates were 17% to borrow money. Are we talking about low single digits?
Yeah, I think, important to address the kind of elephant in the room about interest rates, inflation, what it's going to do to markets. There's a lot of misinformation out there at the moment about it. So historically, there's been 6 rate hiking cycles from the Fed, which isn't a lot if you think about it over 100 years. Every single time the market's been higher a year later. So we just need people to understand that. The last rate hiking cycle we had, it started in 2016, it ended in 2019. They hiked rates, I think it was 9 or 10 times. The equity market went up 40% and the NASDAQ went up 80%.
So, but hold on a second. Hold on a second. Yeah. I mean, no, hold on a second. Now, someone sat me down last week and they said, in the history of the dollar, US dollar was created in 2014. And in the whole of the number of dollars printed between 2014 and March 2020 is less than the number of dollars. I put it to you that a contributory factor, if there's more of something, it's worth less. The lira, the Deutschmark. That actually people are in denial that a contributory factor to inflation and why it might last longer is this money printing. And I put it to you, it's just pumping air in the balloon. And it may not be, leaving aside the technological factor, it may not be as durable as you're saying.
So you're right. So QE, policymakers stepped in globally in March 2020. They learned from the mistakes in 2008. And they, as we all know, embarked on QE, where they grow their balance sheet. It's not technically money printing. They're just switching reserves for risk-free assets, but just allowing that for a side. They now need to unwind that, and they need to do it slowly.
How?
So first of all, they stop buying. right? That'll be the first step. The second step then to do is they stop reinvesting, because at the moment, if you buy a bond 5 years ago, it'll mature. You know, 5-year bond, so that matures. So historically, they've kept putting that money back into the market. So you keep the balance sheet flat, but you're reinvesting it. They'll slowly stop doing that. The first leg of it, we actually think, won't cause as much disruption, because there's about $1.5 trillion of excess cash that the US banks give back to the Fed every night. That just sits in the Fed. So that can buffer the initial unwind. After that, they have changed their policies from the mistakes they learned in 2012, 2013, to put in a thing called a standing repo facility, where basically banks can go to them at any point in time and lend them treasuries back to the Fed, and the Fed will give them cash. So essentially, if JP Morgan was ever short of cash, it wouldn't have to sell anything. It could just take some of the treasuries it owns and gives it to the Federal Reserve. So it doesn't mean it's not a problem at all, and it's going to be tricky to unwind in this inflation environment. It's just not the foregone conclusion that markets and commentators at the moment are predicting.
Alan, I want you to come in on that, and also I want you to pivot to currencies, because if the Fed is doing one thing and the ECB and the yen and so on, what's your outlook for currency variations? But answer the point.
Well, I think the worry I have, and I think I totally accept what Phil is saying, is that I think the central banks are behind the curve here. They've fallen behind the curve. I mean, inflation's already got up to 7% in the US, 5% here. They should, but this time, in most cycles, they would have raised rates, you know, not just once, but 2 or 3 times. So the danger is that they're wrong on the inflation call, and they have to be more aggressive on the rate hikes to get it back down again. The more aggressive they become, you know, the bigger danger to the economy. They slow the economy down or put it back into recession, which is bad news for equities. You know, now I'm not saying Phil is wrong on the equity outlook. It's quite possible that equities will still do well overall, but I think that you have to take that into account.
Okay, and the relative currency.
I think the fact that both the Federal Reserve and Bank of England will be hiking rates while the ECB stands pat. That's what we think at the moment, because the ECB seems to be, you know, ignoring the inflation data. To me,
despite the Germans.
Despite the Germans, we've seen 2 Bundesbank chiefs resign from the ECB, you know, in the last 10 years. I think basically they're fed up with the doves. That's the people who want rates low, calling the shots on the ECB, you know. I think the dollar and sterling will rally, will strengthen against the euro, certainly in the first half of the year.
So if we're talking about 83, 84...
Could be down to 80.
Right.
Which is bad news for you know, people here importing goods and all that. It's more expensive for exporters. So I think there's issues there, you know. I think the dollar, again, I think it's had a good run, but I think it's going to, you know, strengthen against the euro.